You're listening to Macro Sunday, hosted by Andreas Steno. Happy Sunday, folks, and welcome to the Macro Sunday podcast. I'm Andreas Steno, founder and CEO of Steno Research. As almost per usual, I'm joined by our head of research, Emil Moller. Great to see you.
Cheers. Cheers.
We're going to discuss today whether energy stocks are the new bonds.
Yeah.
Can energy replace fixed income in a portfolio? I'm very open to that. And if we look at the empirical evidence over the past couple of years, it's actually a pretty decent notion, this one.
Yeah.
But we're in good company for this discussion because we've re-invited one of our friends, Warren Pies, one of the best energy analysts out there, to join us in 10-15 minutes to talk about this energy theme.
Yeah.
So before we get to all that, Emil, it is always a good idea to run a disclaimer in the financial podcast. And we have our very own disclaimer by Gennaro Gattuso.
Bring him out.
Make sure to remember that our trade ideas...
sometimes may be good, sometimes may be shit.
Yes.
Bring
it twice.
Run him double. Yeah.
Emil, with the disclaimer out there, let's talk a bit about markets.
Yeah.
We've had a week with a lot of focus on price action again, both in terms of financial markets, but also price action in the real economy, namely inflation reports.
Yeah.
So, from a headline perspective, U.S. inflation, a stinker? Or what's the takeaway here?
I don't think so. I mean, we've sort of been talking about this for the past couple of months. As we've seen energy prices coming up, we will probably see that reflected in the headline inflation print at one point or another, right? And here we are. So, surprised? Not really. That being said, am I worried in the grand scheme of things about price pressures in the U.S. economy? Not at all.
I mean, the good story here is that the two components surprising to the upside in this inflation report, we basically know that live prices are lower than what's penciled in to that inflation report, both in energy terms, but also when it comes to housing costs.
Yeah.
I'm a bit puzzled why it takes so long to bring this shelter component down. But at least Jay Powell has told us not to look too much at it.
No.
Whether I truly trust that is a completely different discussion. But Emil, one thing is that the two of us can agree that outside of these couple of categories, it doesn't look that bad, this inflation report.
No.
But what's the conclusion within the Fed? I mean, that's basically much more important than the two of us. Right?
Yeah. So I think that, and I think the minutes sort of revealed this, that the majority of the members are on the higher for longer camp. And I think it sort of reflects that I think they're more worried about their own legacy and their own reputation and getting things wrong and getting, ruining their own accord rather than actually thinking about the momentum in prices. I think it's completely feasible that this inflation report would sort of cement another hike, which to be fair is not something I've been. I'm not super surprised by it, even before this inflation report, to be honest with you. But I think it will be the last one, unless we see some geopolitical turmoil or whatnot, and they will have to respond on energy price pressures. But I think that unlikely. Nonetheless, at least it would be pathological in any sense. So that's where I stand on it.
I tend to agree. I think they will hike, as they've basically, quote unquote, promised us to do in the dot plot. I know that is not a promise, but it's at least a modal outcome or a base case. And the minutes also revealed that they're very, very careful in terms of promising anything at all. But I'm just of the view that if you look at data coming in, say, over the past 3-4 weeks, I cannot find an excuse not to hike, given that it's already the modal outcome.
Yeah.
I know that all central banks are extremely hesitant to move further now. Take the Swedish Riksbank as an example. They have a mess to deal with in commercial real estate space. And yet inflation is not coming down fast enough. Inflation printed at 0.5-ish on the month in core terms in Sweden as well this week. Ouch, if you don't want to hike anymore, right? I mean, if that would have been an inflation print taken in any other context, you would have said immediately they need to hike.
Yeah, absolutely.
And yet markets are not overly convinced that more than one hike from here, from the Swedish Riksbank, is on the cards. So market pricing for the Fed is I'd say surprisingly dovish as well still. Say by the time of recording, ish 35% probability.
Okay, on the next one. I thought you meant on a longer, like going into next year.
But I look at the rest of the year here.
Okay.
So I mean, the market is not convinced that the Fed will have the guts to move once more.
No. I think that's one element of it. The other is perhaps markets are just less keen on buying into the perspective of demand side being able to keep up. I think that's another element. Perhaps Warren can enlighten us a bit on that front.
But before we get to the energy discussion, I want to play a highlight from one of the FOMC press conferences almost exactly 2 years ago. Jay Powell talking about how prices will prove to be transitory. Here it comes.
If we do see that inflation expectations are moving up, or inflation is on a path to remain well above our goals and risk of setting us off on a period of high inflation, then we'll use our tools to guide inflation back down to 2%. So in the end, it's not going to be. In the end, it will be transitory, and people need to have.
The funny thing here, Emil, is that Powell basically claims that in the end, prices will always prove to be transitory.
Yeah.
So I guess ultimately it boils down to the time horizon of the word transitory, right?
And what it takes to get there.
Yeah.
Right? I think that's probably the big one here.
We're sitting here a couple of years later with inflation running way too hot still.
Yeah.
Or at least if you would have asked Powell a couple of years ago, would you accept inflation at, say, 4%-ish in 2 years? You would have said, no, we're not going to accept that, right?
No, obviously. I think I mean, it's so simple just to think of things in terms of, the usual textbook stuff. I was always on, say, I don't know if transitory was quite the catchphrase here to categorize the camp I'm in, but I expected inflation to come up and the Fed to follow suit. The latter didn't do. At least it took some time. But essentially, I thought that we will have higher price levels, but essentially, the growth in prices would have to come down. But that would take some doing on the Fed's part. But I didn't anticipate that inflation would get quite as hot as it did. But I partially subscribe that to the Fed being late to the party.
Yeah, I agree. And they even printed money while inflation was going up. So
buying mortgages.
Wow. The point here, and the reason why I play this soundbite, is that we're now in a situation that is a bit different from an inflation perspective to the first wave of inflation. Sure, we've seen some signs of reaccelerating inflation pressures in some categories. But I'm of the view that with very tight monetary policy, also in balance sheet terms, you simply have a different scenario for prices to sort of develop within when we see rising prices in energy space. So when the oil price is accelerating now, it likely leads to negative pressures on other price categories since the excess savings are depleted in households, since the money growth is negative, all that.
Exactly.
I mean, the scope for energy prices to sort of move along the supply chain and push prices higher in sort of all cost categories, right, left, and center. I don't see that scope this time around.
No, I agree completely. So what basically is the name of the game here is that if you think of spending as being somewhat fixed or at least skewed towards a decrease, and on the other hand you have supply fueled cost pressures which cannot really be received without cutting on expenses, then that's the playbook, right? I do think that what might be a bit tricky here is that that the energy surge that we already have seen could spill over into some necessity baskets, complicating the prints we see in the coming months, even though that energy prices seem to be, I mean, famous last words, have been topped, right? And then again, you have all the geopolitical turmoil. I mean, what if we get another, say, blockade in the Suez Channel? Right, there's plenty of
after the action in the Middle East here.
Yeah, that sort of thing could happen. You shouldn't rule it out. So I think it's a bit more murky than what the usual economic trajectory would tell us here. It's politics is really essential here.
Yeah. So I think it's time to introduce Warren Pies, our guest of the week.
Yeah.
Analyst at 314 Research. Covering oil markets, among other things. And Warren is of the view that energy stocks are the new bonds from a portfolio perspective. And I think that's a very interesting thesis. And before we allow Warren to elaborate on that, let's introduce him with a bit of music. And I guess given Warren's expertise, nothing works better than the Chet Cook Band singing Oil Man. So here it comes. Reintroduce Warren Pies of 314 Research to the Macro Sunday podcast, a friend of mine, but also one of the best analysts out there covering energy markets week in and week out. Warren, welcome to the show once again.
Thank you for having me. Appreciate it.
Warren, you and I have talked a lot about energy markets over the course of the year. You run a very quantitative approach to the oil market, and oh boy, you've had amazing results with this approach to the oil market over the past years here. So, Warren, lately we've seen a sell-off in oil markets after we reached almost a uniform positioning and uniform view among sell-side analysts on the oil market reaching $100. So what made you change your sentiment, or what made your quantitative approach change your sentiment lately?
Yeah, I appreciate that. Really, our view has been this entire year that the driver for the oil market is going to be two things. Number one, positioning within the hedge fund space, really, and we track that in our own way, short positioning, and then the willingness and desire of the Saudis to push the price of oil up. And so these are the two big drivers. China is out there. It's been a concern, but we've thought that China is going to grow and continue to grow, and that's happened. And so the Saudis really wanted the price up, and they really wanted the speculators to get out of their short positions. And so this has been the main dynamic we've tracked within the oil market this year.
And now that we've seen a sell-off, we've had a load of discussions in markets over the past week on whether this is a sign of waning demand for oil ultimately. So what are your thoughts around the demand side of this equation at this juncture? Do we actually see waning demand out there?
I think there is a little bit of a softening of demand when we get to these price levels, but the numbers are overstated when you look at the EIA. And I think the way you see demand softening is really on the refining side. And this is what we've always pointed out. Refiners are the ultimate buyers of crude oil. And basically what we've seen is gasoline crack spreads, which is your profit margin on refining a barrel of crude oil into gasoline, have fallen precipitously in the last few weeks. So that hurts your refining economics. But distillate, which is your diesel and middle distillate side of the equation, has been just fine. So when you put these things together, it really hasn't reduced refining throughput yet. But that's, if we continue in this path, then that would happen.
So, Warren, the $100 mark for the barrel of oil, is that within reach? Do you think we will ever get there in this cycle? Or what should take away from all of this, trying to sort of equate both supply and demand here?
I think, our call was for $100 oil. We made that call back in July. And we got to 97 and change on dated Brent, which is our benchmark. So, I would say is that the high for the year? It's hard to say. It honestly comes back to that positioning question. We've seen hedge fund positioning go from excessive short positions all the way to excessive long positions. And we need to get to tomorrow's update on that data, really. If we've seen those short positions start to creep back up, if there's pessimism coming in, if they're buying this falling demand story, then, that could reset us for an end of the year rally. But this kind of to me, this tells us philosophically, it justifies the way we look at the oil market, which is through this quantitative lens. If it's really difficult in oil to just make a prediction out in the future, everyone does it. Yeah. But to just say, okay, oil's going to 100, oil's going to 120, there's path dependency all over the place. Just the old phrase in commodity markets, high prices cure high prices. And so as we move higher, things start to happen. Things start to happen geopolitically. Things start to happen on the supply side, the demand side, all around. And so I really go back to that first dynamic that we're talking about, which is hedge funds got too bearish and the Saudis wanted to teach them a lesson. I mean, they were really direct about that. And so I think they've done that. They've taught the lesson. And so from our methods, we thought that would drive the price up to about $100, which is what we've gotten. And then at that point, I think the Saudis start to take their foot off the gas. Now you have obviously all the geopolitical stuff going on in the Middle East right now. It doesn't directly impact oil supply, but if it were to start to involve Iran, which Iran, if you look at exports of oil into China through Malaysia, they've 7x'd over the last since the Russia-Ukraine crisis. So that's all. Malaysia produces no oil, so that's all Iranian shadow oil that's coming into China, really. And Iran has been a big source of supply. So if Iran gets pulled into this, then things could really go crazy, and that $100 number could be too low. But we don't know. That's not my game. Is not to predict that stuff. And I don't think very many people have the ability to predict that very well. All we can do is identify that these are potential drivers that we have to watch, and then let the data tell us. So let the inventory data tell us, let the physical market data tell us, let the positioning data tell us, and ultimately the price, the technicals tell us where the health of the market lies. So at the moment, our model is neutral. It's been neutral since I think September 14th. So we caught the rally from early July to September 14th, and now we're neutral. My guess is that positioning flips the model to get increasingly bearish here in the short term. And if you look at like API data yesterday, we could get another big build in the crude oil markets here, which wouldn't surprise me. So the inventory component of the model has also been bearish. So putting that all together, I don't expect an imminent, outside of a geopolitical event that I can't predict, I don't expect an imminent revisitation of that $100 level. I would expect more choppiness to weakness in the near term for oil. But as we roll into next year and all these things start to happen, pointing far out forecasts are worthless. And, it really has never been my thing. I think you can put a little bit of a target out there and say, if these things happen, that's where we should go. But you have to be flexible.
That's one of the things I love about your approach, Warren, that you do not make promises that you're not able to make. And this is a great example of it. Let the numbers talk for themselves. And your model is tremendous at doing exactly that. Warren, the ramifications for other asset classes of the move that we saw in energy, say from July to mid-September, were quite material, both in bond space and in equity space. We saw sort of cross-asset correlations to this move in energy prices. Maybe it was even one of the reasons why the bond market started reacting to energy prices despite the potential for a pause from the Federal Reserve. So what do you make of the oil market's significance for the bond market right now?
I think it's pretty important. I do think, we were also bearish on bonds for going back to, it was our least favorite asset class going back to early June, when we saw what we could tell that there was no recession this year and that the bond market was priced for a recession. And then the other side of that was the supply wave that was coming online. And so I do think if you look at when yields started to take off, that was around the supply announcement, QRA, at the end of July. And so to me, that's the big driver. That's been the big driver, is this realization that we starved the market of supply during the first half of the year. Those yields were probably artificially low. There was concerns around the banking system, et cetera. And then we came into the second half of the year where the economic outlook had improved, and the supply outlook, more importantly, had gotten more bearish for bonds. So I think that's the real proximate cause. But oil is a huge driver. I mean, of course, the Fed's going to say they only look at core CPI, and Fed policy is going to go off of that. But I still believe when you zoom out of these asset markets, that low oil prices, artificially low oil prices for the years from like 2010 to 2020, was one of the biggest disinflationary drivers that allowed yields to stay low. So I think we're out of that period. I think we're now into a period, if you want to call it a secular bull market or a super cycle or whatever it is. But I think that the lows in oil are going to be higher than they've been. And I think the highs are going to be higher as well. And there's always going to be chop in the oil market. And what that means is that, I think that has implications across assets and for Fed policy, for inflation. I don't think that there's going to be a period of time anymore where the Fed has to fight to get inflation up to 2%. Fed's going to be fighting to get inflation down to 2%, as we've seen. I think this is the new regime that we're in. And so when you see oil spike like this, it's not surprising to see bond yields spike along with oil. And I think that on the margin, that's going to be an impact for yields and then ultimately for the market, because I think yields are driving risk assets at this point in time. So as yields go up, bonds sell off on the back end, you're seeing the equity market get hit and be repriced. And so this goes back to, we wrote a report last September and titled it that energy is the new bonds. And the whole concept is, when you play all this out, you need to find new diversifying assets. And I really do believe that energy is one of the best diversifying assets. You're no longer just in this world where the only thing we worry about is recession. We have to worry about recession and inflation. So growth plus inflation are concerns now. So you need, if your base portfolio is risk assets, you need to diversify against both of those risks, growth and inflation. And energy is one of those few assets that can, I think, help you on diversify that inflation risk away. So it's been a driver, and I think it justifies a higher structural energy weight in portfolios.
Yeah. I perfectly agree with that conclusion, Warren, and no one's done better work on assessing the energy component of the portfolio construction than you guys at 314 Research. If our audience wants to find out more about where to look for clues on the oil market, etc., where do they find you guys, Warren?
Well, you can follow me, Warren Pies, at Warren Pies on Twitter or X or whatever it is now. 3F_research is the company Twitter handle. We're still, you and I are still collaborating on the energy cable. So if you want to see how we've navigated the energy markets, I think we've done a good job. The both of us during this cycle and this year that we've done this collaboration, and you can go sign up for the energy cable Substack. It's not a very expensive way to see where how we've navigated this market and kind of how we look at markets philosophically. So those are some spots where you can find us and find our work.
Indeed. And once again, thank you very much for being with us here at the Macro Sunday podcast, Warren. Again, I always say to my sparring partners, if you want to know about the oil market, then go talk to Warren Pies. And I sincerely mean that. Full endorsement from my side. Thank you for being with us, Warren.
Much appreciated. I really appreciate that, Andreas. Thank you for having me and for the collaboration.
Emil, we're back from the interview with Warren Pies.
Yep.
So, first of all, energy stocks as the new sort of fixed income component of your portfolio. Do you buy that notion? I'm a fan myself. I mean, what are your immediate thoughts around that?
So I think there's some compelling arguments as to why you can think of them as such, but the economist within me can't help screaming equity risks and discounted cash flows and all that stuff. But I would probably concede to the fact that you should probably as you adjust your beta portfolio, you should probably, if you go on more defensive side, you should probably increase the amount of equity or energy equities that you hold. But as an actual bond, I'm probably a bit more skeptic, even though I like the arguments. Put it that way.
So obviously they're not bonds.
No.
The reason why we dare saying so is that they've worked well as a portfolio diversifier, I'd say, over the past 3-4 years here. And bonds have not.
No.
So I mean, that's obviously the big thing here. Before we went on air, you posted a tremendous chart. It's very simple, actually, on U.S. Treasuries and the return profile of, say, 100 basis points of moves in one direction versus the other direction in yield terms. And basically both given coupons, but also given the convexity, you can say, you now have a skewed outcome space to the upside from a return perspective, holding long bonds. That is a very, very compelling argument to start buying them again. I have to admit that, because we're talking plus 2 to 1 here. So, I mean, what speaks against buying them here, the long bonds, Emil?
Well, how many buyers are there left on the long end? That's probably the
it's a bit of a consensus view still, right?
It is, and I think it will turn. And I think what we really want to see is blood in the equity market and risk off, and people getting stuck into bonds. I mean, we see a lot of activity in the TLT, which is a bit strange, and it's not really a risk off move when people they buy call options, right, left, right, and center. But I think it's an interesting thought. I read a piece here this week about the Chinese stimulus package, and I couldn't help elaborating on either way how they implement it is still. I mean, we don't know the full scale of the details, but it seems at least they, in some capacity, are committed to to helping out the local governments and whatnot. But in any event, I think it would, at least intuitively, it would create more headwinds for the yuan. And I think that could transcend into lower inflation expectations in the US. And I fear that might be coupled with higher real rates could be detrimental to equities, and we will have that whole phase paying out. So, well, for now I'm on the sideline when it comes to chipping into bonds, as you well know. But as I have been yelling about for weeks now, I'm a kid outside the candy store here. I really want to get in, but I let the idiots catch the knife first. And hope I don't look stupid on the other side.
Is that what you call me nowadays? Speaking of bonds, Emil, and whether they can sort of be reintroduced as a hedge in the portfolio, the energy question is obviously relevant in that regards.
Yeah.
And before we enter that energy discussion, because we've made some pretty groundbreaking statistical stuff on the EIA report. So the weekly report on inventories and production numbers on gasoline, diesel, oil, etc. I'd like to play a brief soundbite for you from the Joe Rogan show, talking about energy, but in a slightly different context. So here it comes.
Oh dear.
I'm drinking like Monster energy drinks sometimes, which are like piss magnets. They're delicious, but they make you want to pee.
Make you want to beat your wife too, dude. I've seen a lot of dudes drinking Monster that they're going home to punch.
Guys drinking Monster apparently
horrible.
Going home to punch, according to this redneck here. But I love that soundbite. I've heard it, I don't know, 1 trillion times. In any case, Emil, we had a landslide in the oil price after the report from the Energy Administration in the US roughly 10 days ago. Yeah. We got an update on Thursday again with a rebound in barrels equivalent of, say, 900,000 barrels a day in the gasoline demand. Yeah. Basically back to where we were. And we didn't get the sort of true comeback in the oil price. We've seen something. Yeah. But it goes to show that the first headline truly managed to just pull the rug from under positioning. Yeah. And then the second headline, when everything returns to normal, didn't really catch that much of an sort of an attention vibe. No. Probably also as some of the quote-unquote tourists or generalists involved in that oil bet suddenly looked elsewhere. Yeah.
And I think that a lot of the positioning was perhaps a bit stretched, and that's why the first whim of trouble, they all all left town. It's a weird one. I got one of our students to look into the details of the EIA report, and you followed up on it. And I couldn't quite make any sense of it from what I could see in the activity gauges, and I think you did a fine job in that study you wrote on it. But I think that whole discrepancy between price action when you get the bad surprise and then the normalization, that's a bit telling. I still think that geopolitics here is in the front seat a bit. So temporarily, I think we could see oil bouncing a bit back on it, but probably I would be extremely surprised if we see anything like $100 a barrel or something insane like that. I don't think that's really in the cards, but temporarily, I think we could see some panic in it, and that could get ugly. But on the other hand, I mean, if Blinken he succeeds in caving out some sort of deal in the Middle East, and the Saudis they concede to hiking up production and whatnot,
and it's game over. Right?
Yeah. So
a positive game over.
Yeah.
But that it's game over for the bull market in oil, at least short term, if that happens. Yeah. We've changed some of our exposures to the nat gas market instead. Luckily, we basically made that shift spot on.
Yeah, it couldn't have been any better. bit unbelievable.
We received some help from the Australians closing down the Tamar field outside of Israel. We received some
shenanigans in Europe as well.
Yeah, exactly. So I mean, this bet on natural gas right now is very weather dependent short term. We have to admit that since storages are running full, meaning that if we do not get to a net withdrawal from storage capacities in Europe, for example, then Europe will simply have to redirect LNG ships elsewhere. And to China, Korea, wherever, right? And that's something that seemed like a pretty decent risk a few days ago, but now the temperature forecast is relatively cold for the rest of the month here, meaning that the temperature part is now playing ball with the view of being long natural gas, and the fundamentals are strong. I think we see increasing industrial demand, and the supply side is just very, very contained here.
Yeah. But I think I mean, when you're into such a bet where you're basically sensitive to weather forecast, you should be, you should pay attention. But I would like to pick your brain a bit on, say, the internal situation in Europe on this front, because I mean, I don't know if you've seen the price action here lately, and in Europe, it's been. We're not quite back to the hyper crisis levels, but at least we're seeing rate of change levels which are not exactly calming. And what do you think? Okay, but what do you think could? I mean, if that ship really starts to take in water, what would the European elite play out here?
I'm not sure that I find the scope to be particularly obvious or feasible for a new aid package for heating, electricity, stuff like that. Obviously, you could remove some taxes and stuff like that, but at least the European Central Bank has told politicians very clearly: should you start throwing money at the problem again, we will continue to hike rates as a response to that. Since we cannot accept that you artificially keep up demand. I mean. My favorite meme, since I've made it myself, is the meme of Christine Lagarde wearing 15 layers of Prada, saying, "I will hike rates until you morons understand that we cannot use more gas than we have, and we do not have the same amount of gas as we had before. 30 to 32% less daily flows. So you obviously need demand to be down, say." 30%-ish for these things to remain in balance. And it is just, as soon as there's little hope, the industrial demand obviously starts picking up slightly. We've even seen a pickup in industrial demand in Germany, albeit a small one. It is a pickup from abysmal levels, basically. So there are signs that the demand side will try and catch up a little bit to a very contained supply side. So if the weather plays ball, the long nat gas bet is still interesting, I think. But it's one of those trades you have to be able to stomach. When we entered the Henry Hub front month, I think I went to take a dump, and then after that, it moved 10%, right? And then I went to the toilet again. But you know what I mean, right? It's really, really one of those positions you have to carefully risk manage all day. So enough about that. Nat gas is for pros. And you could probably discuss whether I am
I think
allowed to call myself that.
so I think sort of the interesting dynamics here with that sort of price pressure, if that really plays out, here's the other side of the story, right? Real wages in Europe, are they particularly impressive?
No.
Are there plenty of trade unions who are discontent with the ongoing situation? Would that transcend into political pressure? That's another part. And then this is, I mean, we haven't really seen this, but I think it's an interesting idea at least. So who are the main beneficiaries of higher energy prices in Europe, at least in local terms?
It's hard to
Norway is a good shout, right?
US, right? But
but
if you consider that local, at least
but
Western
Europe,
local,
the European Union doesn't have that much leverage on the US, but if they wanted to. Really committed to it, even though I mean we like our Norwegian friends and everything else as Scandinavians, but I think you can make a pretty good argument that the European Union should try to emphasize pressure on the Norwegians to lower the prices, essentially. And if not, they should come back with some sort of retaliatory policy. I don't think it's quite in the cards, but it's something to keep aware of if you play this game in Europe, I would say. Both of those components.
Yeah. Now we're starting to lose followers in Norway after this year.
Oh well.
And I need to bring a helmet next time.
Get out the tomatoes.
Exactly. Emil, let's leave it at that for this week. Always a tremendous pleasure to discuss the macro markets with you.
Likewise.
Let's see for the week ahead. We're still long nat gas. If you want to track our entire portfolio of macro trades, then go to stenoresearch.com. We'll leave the link to the subscription landing page in the show notes. And remember that you can use macro30, macro30 to get 30% off the first part of the subscription if you want to know more about us. So I guess it's time to say have a great Sunday out there and see you again in a week from now.
Sometimes maybe good, sometimes maybe shit.